Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back and welcome to Traders Corner, and as always I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi Juliet.
Garth, unfortunately we have to start the show on what has been a rather frustrating note for you, and that is the trade that you enacted on Naspers last week. And to see it rally today and yet to have a huge fall last week must be extremely frustrating.
Yeah, it is quite frustrating, but you know, this happens in trading. I mean, I've been doing this long enough to know that this sort of thing happens from time to time, and you know, the key with trading is to keep your losses small. They're going to come around now and again. It's just the nature of the game. So I don't get massively upset about a loss, but it is unfortunate when you see a trade that, you know, got stopped out and then it does start to work again afterwards. Anyway, look, be that as it may, there's certainly some lessons to have been taken out of this. And if we have a look at the chart of Naspers, which is up on the screen at the moment, we'll have a look through and see what I was seeing here and why I did the trade. Now, the first thing is that we all know that Naspers is an incredibly strong stock. It's got a hell of a lot of momentum behind it, and it's in a very strong sector of the market as well, being the industrial sector, which is the leading sector in our market. Now, one of my favorite types of trades to do is to look for a stock it's a strong stock in a strong sector and it's been consolidating for a period of time, because usually that's sort of synonymous of the share catching its breath in anticipation of a break in the direction of the prevailing trend. And what we had over here was a consolidation that had been lasting nearly a month, and it was a triangle pattern, as you can see illustrated on the chart over there. Now, statistically, these patterns break out in the direction of the trend 2 out of 3 times. So 66% of the time you would say that this is going to break higher. Obviously that also means that 1/3 of the time it's going to break the other direction and go lower, which is what it did here. Now you could argue,
dramatically so.
Yeah, that's right. You know, so we bought. I mean, I took a small position last week. I only bought 160 CFDs at 942 rand, with a stop loss at 919. Now, the thing that I didn't do here was I didn't wait for a breakout through the top of this triangle pattern, which would have made it a safer strategy. Instead, I went in anticipation that this would break out to the top side. Now, that in itself brings in a little bit of extra risk, I suppose. The fact that I was assuming something would happen, which most of the time it would be right. But of course, it's always safer to actually wait for that breakout and then initiate the trade. But by trying to preempt it, I effectively managed to achieve a better risk to reward ratio than if I had have waited for the breakout. So look, anyway, that's the lesson, I suppose, and wait for the breakouts to happen and instead of trying to anticipate them. Anyway, the rest is history. I mean, we did get stopped out at 918 rand 80. That was actually an automatic stop loss that I was using in that occasion because I wasn't in front of my screen that morning. So it did drop quite quickly, but nonetheless, the automatic stop loss pretty much got us out close to where I wanted to be out anyway.
And that's pretty good that it did, because it went down to 900 rand, didn't it?
Yes, it hit 900 in the low. I think it might have even gone slightly underneath 900 rand briefly. And then it's rebounded quite nicely after that. Anyway, look, we lost 4,352 rand there. My risk, our capital risk on this trade was 1% of our capital. So if we did lose that plus some transaction costs. So, you know, when all is said and done, we probably came out with a loss of about 1.3% of our money on this trade, which is certainly not the end of the world.
Yeah. Garth, it's quite interesting to see what's happened now the second time with Naspers, because it was one of the earlier trades that you put on for the portfolio this year. And almost the same thing happened. And then, of course, we've seen this huge rally. And it's hard not to take it personally. And then you think, well, I'm going to trade this damn thing until it does what I want it to. Yeah. Do you ever succumb to that sort of emotion?
No, that's called revenge trading, and it doesn't work. I've learned the hard way that revenge trading is a waste of time. You know, revenge trading is where you lose money on a share and then you say, all right, I'm coming to get my money back from that same share. Yeah. And it's a completely silly exercise to do. You know, like I said many times, you know, shares are not marriage, there's no love involved. You can't fall in love or hate your shares. They don't love or hate you back, right? They're just shares and they don't owe us anything. So Naspers cost us money this week, so be it. It doesn't owe me anything back. Right, I'll go and find the next trade, and I'll make some money on the next one, hopefully. but it doesn't have to be on Naspers.
No, but clearly it's an emotion that I think is suffered by a lot of people, if it even has a name.
Yeah.
So I didn't know it was called revenge trading. Now I do.
Yes. No, it certainly is a common emotion that people experience in trading, and they feel like they need to go back and get the money back from that stock. You know, it's pointless. Don't worry. You know, these shares don't love or hate you back. They're just shares. When they don't work, you get out. We practice good risk management like we've done here,
Yeah.
and we move along and we look for the next trade. And you know, losses are part of trading. It happens. As long as you keep your losses small, which I'm happy to say we've been good at doing on this show since it started. We've always kept the losses small, and as a result, you know, we've been consistently profitable.
Yeah. Discipline, that's the other big issue. Guys, so if we look ahead, you've got a new trade on this week, but I know you want to talk a little bit about the put option structure that I suppose you enacted a couple of weeks ago.
Yeah, we did this trade on the 1st of October, and I know people ask me about it quite a lot because it is quite a complex trade. So this is just the net payoff on this structure. If you want to see how we constructed this thing, you can go and watch the video from the 1st of October when we put this trade on. But in very basic terms, this axis along the bottom here is the level of the top 40 index. So we've got 35,000, 36,000, 37, and so on and so on. And then on the y-axis here, we've got the profit and loss curve. And what this chart really shows you is that we've got a structure in place here which gives us nice downside protection if the market were to go lower. Now the point is that I'm not turning bearish on the market. I've really put this in as an insurance policy for the final quarter of the year, really. What it means, really, if you look at this payoff, anything above about 39,800 or so, we stand to lose a maximum of 6,600 Rand on this structure at that point, which is less than 2% of our disposable capital. Below that 39,800 level, then the structure starts to make money, and it makes its maximum profit at 37,000 on the index. That's where we could potentially make 53,000 Rand. And then it starts to give that profit back on the way down, and it starts to move into loss-making territory again, underneath 34,350. Now, I think this is a nice structure to have in place as insurance, given the uncertainties in the world at the moment, given the US debt ceiling and the government shutdown and all that, which does sort of look as if they're going to resolve that. I'm sure they will. But, nonetheless, this is cheap insurance to have in the background. I'm predominantly a long biased trader, which is fine, but it's nice to have downside protection like this in place. It certainly gives me a lot more comfort and confidence to know that I've got some insurance if we do see downside in our market.
And certainly you can trade sort of more freely because you've got that insurance in place. So you don't have any psychological stumbling blocks in your path, which can also affect one's trading quite significantly.
Correct.
Garth, but having said that, you are in fact going long of the market, and that leads us to this week's trade.
Yeah, I am, and I'm actually going long of the top 40. So you could say this structure gives us the downside protection, and then what I'm doing today gives us upside participation. So we've kind of got all bases covered.
Yeah, let's just hope the market doesn't, go flat and become marooned for the next 3 months.
Yeah, we just need it to move one direction or the other. All right, so this is a chart of the top 40 that I've got up here at the moment. And I know that I've said to viewers before that we had an uptrend here running through the lows since June, and that we've broken that to the downside, which I still stand by that. But the point is, we've pulled back now, and we've pulled back quite sharply through the last couple of weeks. And what's happened is that downtrend that's characterized the pullback of the last couple of weeks has actually been broken to the upside over the last day or so. And at the same time, we now sit in a situation where we have what's called bullish reverse divergence. And what that is, if you look at that stochastic oscillator on the top there, it is making a lower low. In other words, the market's more oversold on this pullback than it was previously, but yet the market level is higher. So the market's making a higher low, but the stochastic's making a lower low. And that type of setup very often does result in a fairly sharp and aggressive move to the upside. And we've seen it happen on the top 40 quite a few times over the last year and a half, and each time it's actually worked out quite well. So on the basis of that, I have enacted a trade on the top 40. I've gone long, but I want to zoom in more specifically on that area that I've put the little box around, because this is a daily chart, but this next chart here is an hourly chart of the top 40 futures contract. So each plotting on this chart represents 1 hour worth of trade, and you can see this thing goes back to about the 3rd week of September or thereabouts. Now what's evident to me here is that we have that downtrend. That's what I showed you on that previous chart, the downtrend that's capped this pullback in our market over the last 3 or 4 weeks or so. We've now broken out through the top of that downtrend, which is a bullish sign. So what I've done is I've actually gone long of one contract on the top 40 at a level of 39,300, and I'll put my stop loss underneath the lowest point of yesterday, being Monday.
Okay.
So I'm setting that at 38,880 points.
So quite a wide stop loss, actually.
Fairly wide. It's 420 points, which equates to 4,200 Rand worth of risk. But I'm looking for upside here back to the recent highs, actually. So we went as high as 40,300 on the futures contract. I'm looking for us to potentially go back there. Okay. And there you can see our risk to reward payoff. The red block represents the risk and the green block represents the potential reward, if I'm right. And it's around about 2.5 to 1 risk-reward ratio on this trade.
Okay, so you have put this trade on for the portfolio. If you take us through the mechanics of it in greater detail.
Yeah, okay, so I'm buying, and I've bought already 1 December Aussie future, 39,300. My stop loss is 38,880. It means I'm risking 420 points. And on these futures contracts, every point represents 10 Rand. So that means I've effectively risked 4,200 Rand. And that is, it works out at about 1.2% of our trading capital on this account of ours. We've got about 350,000 in capital. The target that I'm looking at is 40,300, and that means that our risk to reward ratio for this trade is 1 to 2.38, which is okay.
Yeah. And Garth, there's another factor involved here, which, some people may poo-poo this as being rather esoteric, but it's the time of year when, certainly in the last 4 or 5 years, markets have tended to turn quite bullish. They
have, and I've got a chart here showing the seasonality on the S&P 500. Now, I haven't got it up for our market, I haven't done that homework, but this is a chart that's been done by equityclock.com, and you can see basically what this chart represents. It shows the 20-year average performance over the different periods and different months of the year. Okay. So we're going back 20 years here, as I mentioned. It starts in October, so you can see that through October, the market tends to have a fairly strong period all the way up until May, and then it goes flat. So if you look at that yellow section that I've just highlighted there, it basically means that we're just going into this seasonally strong time of the year for equity markets. Whether it works this year or not, look, it remains to be seen. There's no
American politicians could scupper all of this.
Yeah, there's not always certainty in the market, of course, and that's why we trade with stop losses. But if you look at this is 20 years of statistics being crunched together, and it shows that this time from October until April actually is generally it's historically a very strong time for equity markets, and then you get that flat time between May and September, which is where the saying sell in May and go away comes from. So we're into the strong period. So anyway, be that as it may, and we're going long based on this, and we've got some downside protection in place as well. So we've got all bases covered.
When are bonuses paid, Garth? Because maybe that has also something to do with this. Traditionally March, April?
It varies, yeah. As far as I know, certainly in South Africa, bonuses are usually paid in about April, at the end of the tax year. And I don't know what it would be for the rest of the world. I don't know whether that has any factor to play.
I'm just sort of cogitating, wondering if there's a link here. Garth, so what does the portfolio look like then at the moment, given the unfortunate occurrence of the Naspers?
Yes, all right. So well, here it is. That's our Aussie 40 structure, that option structure that we've got on. I suppose net we're about flat on that thing at the moment between our premium and what the futures leg of it is doing for us. Naspers, we lost 4,300 Rand, as I mentioned, and now we're into this long position on the top 40 where we've got a mark-to-market profit of 4,500 Rand.
When did you actually net the trade, Garth?
Yesterday.
Okay.
Yeah, and those who subscribe to traderscorner.co.za would have seen the analysis and what have you in anticipation of this trade. So all in all, we're sitting at just shy of 354,000 Rand there. So up 41.5% for the year to date.
So slightly down from last week, but still a fantastic performance nonetheless. And then, Garth, to end off with the next course dates that you have.
I've just got one course in the pipeline for now, which is an Understanding CFDs course on the 7th of November. It's a 2-hour evening course, so anybody that wants to attend that is welcome to email me, garth@traderscorner.co.za. I will look to set more dates for my high probability trading course in Johannesburg and Cape Town before the end of this year.
And certainly I know I've got a couple of emails from Durban-based viewers who really want something down there, so
maybe there as well. Yeah, that's it.
All right, Garth, so we'll leave it there. Thanks as always for joining us on the show.
Okay, thanks.
That's Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.